Welcome, everyone, to Women on Wealth. And today's discussion, I believe, is incredibly timely around the value and the opportunity that bonds can create in your investment portfolio. I am joined by the bond girl herself, Priscilla Hancock. And the reason I say that is that she spent nearly 40 years working at some of the largest, the best known financial firms in the industry. Following graduate school, she began her career on the trading floor at Lehman Brothers, becoming a well-known speaker and industry advisor on the municipal bond market. And then after nearly 13 years, she transitioned to development and then global product strategy and development at Moody's. She spent time at Standard & Poor's and a brief stint at a clean tech venture capital firm. She then spent, up until her recent retirement, she was a senior global fixed specialist and head of fixed income insights at JP Morgan Asset Management. She created the fixed income triangle, which is one of the firm's and industry's most widely used investment management models. She's a frequent speaker at industry events in the media and is in the media. She holds a BA in art history from the University of Virginia. She received her MBA from Columbia Business School and an executive certificate from the Sloan School of Management of MIT. On a personal note, she is a widow with 3 stepchildren, their spouses, 4 grandchildren, and spends time in New York City and at the Lakeside cottage they have in Northwestern Connecticut. Holy cow. Hi, Priscilla.
Hi, Shalene. It's great to see you.
It is so good to see you. So after going through your bio, let me quickly follow up and say that you and I know each other from spending our time together at JP Morgan. I relied on you as in my role. I was responsible for educating my financial advisors in my region. And you were one of the individuals that I constantly leaned on for your expertise in bonds/fixed income. You were gracious enough to even come in my car with me and travel to visit these clients.
On more than one snowy day, I might point out.
There's nothing like snow on 95. And I will say that your creativity, your simplicity of explaining bonds, it still resonates in the industry. And that's why I'm really excited to have you on, because you and I may be a bit geeky about bonds for clients today, but I really want to help explain and help people understand the power that it can have in an investment portfolio today. So thank you.
Oh, it's my pleasure. I'm happy to be here. And like I said, it's great to see you. We had really great times working together, and I miss those days.
I know. And you and I even tried swinging some golf clubs together at some point.
We did. I think that was a rainy day in Arizona. We did it once. So we have had bad weather.
Yeah, it was a freezing rainy day.
It was.
So tell us a little bit. 40 years in a career is a tremendous amount of time. Tell us a little bit about your career, why you got into bonds, because candidly, there's not a lot of women in the bond market today. I can't even imagine what it was like 40 years ago.
So interestingly, you mentioned I majored in art history in college, so it doesn't sound like that would be a good background for the bond market, although I do have a pretty strong background in math and took a lot of math and science in high school. And in fact, I started college as a pre-med major, but only because I wanted to do medical illustration. So But in any case, I graduated with a degree in art history, and then I needed a job. I needed to earn a living, and one of the areas that I looked into was sales. And I actually went to work for Xerox when I first got out of college, which is a fantastic sales training program. Mm-hmm. But selling a fixed good, was not as interesting to me as talking to the clients. And so I thought that financial services would be an area that would combine my interest in the client. And so that's when I went back to Columbia. I really was unaware of Wall Street, and it was just taking off in the early 80s. It was right when banks start to move the loans off of their portfolio into the bond market, and the real takeoff of Wall Street, if you will, what people think of, really happened at the same time.
Sure.
But there were several people in my class in graduate school who said, you've just got to go into sales and trading. It's so perfect for you. It's a good pace, the right environment. And I knew nothing about it, but one of the lessons, and I tell young women this all the time, is that there are a lot of people out there that know you and know opportunities and know of things that you're not going to know about, and you should listen to them, right? There's a lot of really great opportunities that come from people. And throughout my career, many of the jobs I've gotten have been because somebody called me and said, hey,
Absolutely.
And that was a great lesson for me. And in fact, I went down and spent some time on the trading floor at Lehman Brothers. I ended up getting recruited by them, and I went there. And before you ask, yes, it was, there aren't that many women on the street now. And at one point, I was the only professional woman on the institutional desk at Lehman Brothers. And all I can say is the movies aren't that wrong. Go back and watch Working Girl. It was an interesting environment, but it was also a fast-paced environment. It was a pace where knowledge paid. And if you were good, and I will say that in muni bonds, unlike really the rest of finance, the municipal bond market, the clients, particularly the issuers, state and local governments, had a lot more women in positions of, treasurer, management of monies. And the fact that I was a woman on the trading floor was a really great way to develop a rapport with many of our fixed income issuer clients. And that, I think, was to my benefit. So
that's
the muni bond market was, it was a great place to be in those days.
Oh, thank you for sharing that. And I know you have some great stories behind that.
There are a few. And then I was lucky enough to the point, I would say, my career evolved because a very good friend of mine that worked for Moody's called me and said, the job of international strategist is open. And I said, who would hire a muni bond geek to do that? And he said, just come have lunch with the president and see what you think. And I did. And I thought, well, very few people are going to offer me that opportunity. Well, it was pre-European Monetary Union. And what happened in European Monetary Union was that the bond markets in Europe took off. And I was part of that from the standpoint of Moody's creating product and talking to those clients. And then wrapping that all into talking to clients about how to build a global fixed income portfolio was really a natural third part. So it's been a really interesting career that developed in a way you never could have plotted.
You never imagine it that way. And
never at all.
And that's why I love having you on, because, even though you started in the municipal space, and we're going to talk about this, there are so many different types of bonds.
So many.
And you can speak to them. And so we're going to try and highlight some of that today.
Well, and interestingly enough about the municipal bond market, it's sort of a microcosm of the entire global bond market. And we probably don't have time to talk about it in depth, but there are corporate issuers and government issuers and education issuers and utilities and all the kind of things you feel in the taxable market, housing bonds, all of that exists in the muni market. So it's a real microcosm of the global bond.
No, that's a great point. So for listeners that aren't as comfortable about this conversation, can we start with the very basic, simple, define bonds / fixed income, because they're one and the same.
Well, the fixed income is a catch-all, but interestingly enough, the fixed income is really a misnomer, and we'll get to that. But what's so interesting, you asked me this question and that we had this scheduled for today, because absolutely unprompted by either of us, I received in the mail yesterday my AARP bulletin. Yes, I'm an AARP member. And interestingly enough, it has this article, 8 things you need to know about bonds. And the topic of this one is, what is a bond anyway? So for those of you that have that, there's a little bit more information in that AARP bulletin.
Wow.
So I said it's a catch-all term for bonds, fixed income. A bond typically represents debt. It represents a loan or a pool of loans that have been turned into a security, right? So in other words, you could go to your bank, you get a loan. The bank might take that loan, pull it with a bunch of other loans, and sell it to a third party, to investors like you or me or your clients, right? So the bank no longer has the risk. They've sold the risk to somebody else.
Right.
Those bonds typically pay an interest rate, just like you pay an interest rate on your mortgage. Some portion of that would get passed through to the person who buys the bonds. However, here's the misnomer of fixed income. The interest rate could be zero. We have zero coupon bonds. And in that case, you don't pay 100 cents on the dollar, you pay something less. And in the end, you get 100 cents on the dollar. So your interest rate sort of compounds silently. The interest rate could be fixed, like fixed income says it could be, but it could be variable. It could float depending on a series of different factors. It could be triggered and jump up to a higher rate if the borrower doesn't make a payment, for instance.
Right.
So fixed income is a little bit of a misnomer, but basically, I think the better term would be that's the bond market. I think the bond market is a sort of a broader term. But as you said, there's so many different kinds of bonds.
Yeah, and thank you for going through that, because especially right now in an environment, we're going to go through this as to why, but there was really little interest in owning treasury bonds for a very long time because there was no income. And now all of a sudden there's this heightened demand for treasury bonds, and there are treasury bonds that are zero coupon bonds. And so I think that's a great point on how different these bonds can.
In fact, there are also treasury bonds that have an inflation component. CHIPS, Treasury Investment Protection Securities, and last year, many
also very popular now.
Very popular. Your clients may remember that last year, when inflation was so high, it was written up everywhere. Go buy. Of course, you can only buy $10,000 worth at a time, so wasn't going to move the needle in a large portfolio. But all of a sudden, they became a hot topic. Nobody had talked about them for years.
For
so
years.
It's very interesting.
Yeah.
Right?
Yeah. So before we get into like today's environment, if you can go a little bit further on defining why bonds are important in a portfolio, I think that would be great.
Right. So I think this chart you're showing, that for the people that are just listening, we'll mention, talks about the correlation of stocks. And what does correlation means? It means, do the prices of bonds and the prices of something else, or in this case, the price of stocks, do they move in the same direction at the same time or in different directions? And what has typically made fixed income such an important part of somebody's portfolio is that high quality fixed income. So let's use US Treasuries. They are considered, as I mentioned earlier, the highest quality. Now, of course, we pushed the envelope a little on that earlier this year about whether we would stay so high quality. But the highest quality investment, typically those treasuries are negatively correlated to stocks. What does that mean? Typically, when stocks go up, the price of treasuries goes down. And when the price of stocks go down, the price of treasuries go up. And that teeter-totter, that balance, is an important part of somebody's portfolio. Why does that happen? Think about why stocks go up and down. The economy is doing great. Sales are up. People really want to own stocks. They want to own a piece of that company that's making all that money, right? So the prices of stocks go up. Well, when the economy is doing great and the prices of everything is going up, inflation tends to be going up.
Sure.
And when inflation is going up, the Federal Reserve says, oh, we have to, put the brakes on that. And they start raising rates. And with bonds, rising rates means falling prices. So the stock market's doing great. Pardon?
Like a seesaw.
Like a seesaw. Exactly right. However, what happens when the economy slows and we go into a recession? Ooh, stock market takes a dive. But the Fed says, whoops, we have to spur the economy. Let's lower interest rates. Lower interest rates, higher prices on the fixed income. And that is the balance that fixed income provides in a portfolio. Right. Now, other high quality fixed income would include municipal bonds. Now, not all municipal bonds are high quality, but in general, the high quality municipal bonds are not correlated to stocks.
Correct. Correct.
Core bonds, and we can talk about core bonds later. What does that mean? What's the difference between a core bond and a treasury bond? Well, there's an index called the Bloomberg Barclays Aggregate Index, and I must say that originally it was called the Lehman Brothers Aggregate Index. Correct. So it was founded when I was at Lehman Brothers, and it's an index that represents investment grade debt in the United States. Yeah. Treasury bonds, mortgage securities that are backed by Ginnie Mae and Fannie Mae, which are also AAA, but also corporate bonds. And we're going to come back to that later because corporate bonds don't necessarily act as a diversifier to your portfolio in the same way that treasuries and mortgages.
Perfect.
But those three things are in the index called core bonds, and it also has very little correlation to stocks.
For example, in 2008, right, bonds were actually up that year as we saw the stock market go down 30, 40, almost 50%.
Right. People had this terrible reaction in 2008, and yet you had a positive return on that Barclays Aggregate Index, which at the time was the Barclays Aggregate. And then when Barclays went under, then, I mean, they didn't go under, but sorry, they sold the index. Lehman Brothers sold the index to Barclays as a wrong, but anyways, it's a long story. In any case, it is now the Bloomberg Barclays Aggregate Index. And yes, it was positive in 2008. People don't remember.
Perfect.
Because they have such a bad feeling about their equity.
Yeah. So, and I think that another way to kind of talk about that diversification, right, is well, you go ahead. Sorry.
Right. No, it's okay. No, this is absolutely fine. You have a chart here, and we'll talk about the chart, but there's people that can't see the charts. It's called the Callan chart, and that's advisory firm that created this chart, and it looks like a big, huge checkerboard.
I call it the jelly bean chart.
Oh, I like that one better than checkerboard. Yeah. So basically, it looks at annual returns of different sectors that you could invest in: fixed income, cash, high yield bonds, commodities, large cap stocks, emerging market stocks, and I won't go through all of them. It looks at the returns every year. In this case, going back to 2008, which was, of course, as we know, was not a great year for the equity market.
Right.
In fact, I think if I'm looking at this carefully, large cap stocks lost 37%.
Yeah.
But then it also looks at a typical 60-40 portfolio. And I'm sure many of your listeners have heard of a 60-40 portfolio: 60% stocks, 40% fixed income. That is the asset allocation mix shown in the white boxes on this chart. And for those of you who can't see the chart, what those white boxes are, they hang out in the middle. So they don't have the highest return any one year, and they don't have the lowest return every month.
Yeah.
They are more stable. And in fact, if we look all the way over on the right of this chart, we look at the annualized return from 2008 to 2022 of that asset allocation model, which is 6%, a little bit more. Mm-hmm. And we also look at the volatility. And you can see that the volatility is near the lowest volatility of any of the sectors on this chart. It's just more than 12%. In fact, fixed income is only 4%. Why is volatility important? Volatility is important because in and of itself, is a driver of your compounded return over time. It's pretty easy when you think about it. What does volatility mean? It goes up or down a lot, right? So I can have low volatility. It goes up 1%, down 1%, up 1%, down 1%. Or I can have high volatility. It goes up 10%, goes down 10%, goes up 10%, goes down 10%.
Yeah.
If you think about it, something that goes down 10%, think how much more it has to recover the next year to give you a positive return.
Yes.
It's more than 10%.
It's more than 10%.
Right. And so if you go down 1%, you don't have to recover as much. So a portfolio with less volatility, when you realize that the average annual returns don't need to be as high, you can either take less risk and get to the same place.
Yeah.
Right?
Yes.
Or you can take the same amount of risk and you'll get much higher returns over time. Volatility is really, really important. It's one of the reasons we want to own fixed income. It helps bring down the overall volatility of your portfolio, both because it has low volatility in and of itself, and because high quality fixed incomes negatively correlated to your equity. So if you think about a seesaw, you got one thing going up and the other thing going down, your volatility isn't as high. Yeah. So diversification is the key. I know we talk about it all the time with our clients. I know I'm sure you talk about it all the time with your clients. But a portfolio that's diversified between equity and fixed income is going to give a client a more stable ride, more sustainable returns, not the highs, not the lows, and a better compounded return over time. And that's what this chart shows.
It's such a powerful tool. The analogy that I have always thought of is, if anyone in the Northeast might understand this, but if you were told you need to drive over the George Washington Bridge and that there were no guardrails, where would you drive?
In the middle lane.
Most will
as
say
close to the middle lane, maybe maybe in the middle breakdown lane.
Yeah, no, that's the whole idea of diversification, right? You're never at the extremes. You're never the winner or the loser. Yeah,
that is a great example. So I love this chart, Callan chart, one of my favorites. And by the way, I think a little bit later we'll look at the fact that this exact same approach can be used within fixed income.
Yeah, just to give an idea of how much there is in fixed income. And if we can take it one step further to talk about the volatility.
Right, we just talked about how important volatility is to your overall returns. And if we look at, 1 year numbers, right, we're going to see a lot of volatility in pretty much, particularly recently, in all areas. Stocks typically have a higher volatility than bonds. If we put the portfolio together into this classic 60-40 mix, what we see is that on a 5-year rolling basis, stocks had some negative years. Bonds had a couple of negative years. But a diversified portfolio did not have any negative years, and it did it with less volatility, less highs, less lows.
And Priscilla, just to make that point, it's every 5-year rolling period starting in 1950. Right. Exactly. So, yes, we've had declining interest rates up until recently, but But if you think of the 50s going into the 80s, that was another period of rising rates where
That's
bonds were
exactly
impacted.
right. If you look at a rate chart, and I think we have one later, but if you look at rates over time, they went up from the 50s to the 80s, and they came down from the 80s to today, well, until maybe a year ago. And what this chart shows you is, regardless of which of those time frames you were in,
Yes.
any 5-year rolling period with a diversified portfolio gave you a positive return.
Yeah. Yep.
And that is the power of diversification, low volatility, better returns.
I think it's a great visual. And then
yeah.
This is what we were just talking about.
Here's the chart we're just talking about. So if we go back to the 50s, you know, where were real yields, or where were nominal yields? So what is nominal yields? That means the actual yield on the bond.
Mm-hmm.
The actual yield on 10-year treasuries, you know, was 2.5%. By the way, lower than where we are today.
Yeah.
Right? And yields peaked for that 10% in September of 1981 at close to 16%. And so what people got used to, and I think one of the reasons the last year has been so uncomfortable, was that, you know, we basically had a period of falling interest rates from 1981 to 2021. And with falling rates, we get rising prices. And so people's portfolios kept yielding more and more, except for that they kept returning more and more, except for they kept yielding less and less.
Yeah.
And so for people that use fixed income as a savings vehicle, kind of didn't provide that for a while.
Right.
And so that when we look at that, now I will also point out that the chart you show here shows not only 10-year treasury yields, but the yield you have after you cover inflation.
Right.
And what it shows, in fact, is that you're not getting much. In fact, you're not getting anything. After inflation, you're losing money with your 10-year treasury investment. Mm-hmm. And I would say that personally, I think that's a bit of a misnomer. This is using a core CPI. Mm-hmm. I prefer a measure which is often called sticky core, less shelter. So shelter is owner's equivalent rent, like, you know, what it would cost to rent if you know, as an owner, and then rents. Right. It tends to be a number that really, really lags, right? That data kind of takes a long time to flow through into the inflation number. If you take that number out, the monthly inflation rate last month was 0.01%. You annualize that, and it is still below 1%.
It's amazing.
Sticky core inflation. I mean, the Fed has achieved their goal. And we can talk about what that might mean in a slide or two. But the bottom line is, I think that if you think about sticky core inflation, you are doing well after inflation. So yields have gone up. This chart shows you it's been fairly dramatic. And I think we have another chart that shows pretty much how dramatic it is. Yeah. But you are in a position today where I think fixed income is looking more and more attractive as a portfolio investment. And I mean longer term. This is 10-year treasuries.
And Priscilla, really quickly, why are we so focused on core? You're talking about the importance and the interesting features of sticky core, but why is everyone so focused on core?
So headline inflation, which includes food and energy. Food and energy are highly volatile. There's a couple things, right? Energy, we know, goes up and down. We all know about the price of gasoline that's been all over the place, and it may not be an indication of true inflation for a couple of reasons, not the least of which is that when gas costs a lot, people drive less. Right? You still have to eat. But why is food so volatile? You don't have to eat the same thing. Right. So the Fed actually even has another measure of inflation where they look at, well, like a substitute basket. So things are doing great, everything's doing great, you're eating steak.
Yeah.
Inflation goes up, you're eating chicken. So food and energy, highly volatile, but with some amount of either usage or replacement options. And so the core is a lot closer to what people actually have to pay.
Yeah. Thank you for those descriptions, because obviously inflation has been front and center in the media for well over a year. And I think it can be very confusing when you start referencing inflation numbers. Well, which one are you actually looking at?
Which and what really matters? And I think that's the hard thing. What really matters? The Fed looks at core inflation. They look at it less, less at food and energy. Okay, fine.
Right. As consumers, we may prefer headline inflation.
That's right. But I would bet that somebody at the Fed's looking at sticky core less.
Yeah. Yes. We care about the egg price.
Yeah.
Okay. Thank you for going through that.
Of course.
And so, yes, last year was a very, I'll use the word devastating year for people. Can you quickly highlight Why?
Well, first of all, I'd say it was an aberration. That's the good news, right?
I
So,
like that word better. Thank you.
people say to me all the time, they said, oh gosh, I lost my shirts in fixed income last year. Why would I buy fixed income?
Yeah.
And the first thing I would say is, yes, you did. But by the way, the equity market wasn't that great either, right? S&P fell, let me remind you, 18% last year.
Yeah.
And the Barclays Ag only fell 13%. So neither is great, only is a relative
nowhere to hide.
number. Pardon?
Nowhere to hide.
Nowhere to hide last year.
Yeah.
And why is that? Well, partially two reasons. The first is, why did the stock market fall last year? Right? If the Fed is raising rates, because typically when they raise rates, because the economy is doing great and inflation is doing great, why did the equity market fall? It should be doing great. Well, the equity market got really comfortable with really, really low rates, right? And a lot of companies use those low rates to finance activities and to build up cash positions, right? They borrowed money because it was so cheap. Well, when rates start to rise, all of a sudden, that candy jar that was there for the equity market isn't going to be there anymore. And the investors say, well, are companies doing really well because they could borrow cheap money? Or are they doing really, really well because their business model's great?
Yeah.
And there was a lot of concern, one, that cheap money was going away. And two, that if the Fed is really going to be successful, maybe too successful, they're going to cause a recession.
Yeah.
And typically the equity market hits its bottom 12 to 13 months before a recession.
I think it's a very interesting point right now.
Right. So what you saw last year is people saying, "Ooh, candy jar is gone, recession's coming, equity markets in the toilet."
Yeah.
But then what about the bond markets? Well, bond markets, Fed's raising rates, rising rates, lower prices. And what made last year particularly painful is that you started off with no coupon. So in the bond market, you make money one of two ways. Either with price appreciation, or you lose money if prices go down. And then you have your coupon, your interest payment.
Yeah.
Sometimes, if the prices only go down a little bit, in the old days, you might have had enough coupon to offset that. So you wouldn't have had a great year, but you wouldn't have had a terrible year. How much coupon did we all have going into 2022? Yeah, none.
Nothing.
Right?
No buffer.
So, no buffer. No buffer whatsoever. So yields went up. Prices went down, you had no coupon, you had a really, really bad year in the bond market. And so last year we had, as you said, nowhere to hide. Yeah. Now this year we're having a different experience. Go ahead.
Now I was just going to say, as if you can see the slide, it's that red dot all the way on the right-hand side that was showing at one point during the year, the bond market was down 17%, right? And then we ended the year down 13, which is the bar.
Right. And in fact, I call this chart, so you had a chart for the candy jar chart. I call this the measles chart. A lot of people in the industry call this the measles chart because there's a red dot in every year that shows you the maximum drawdown the market had at that point. Right. And what's interesting about the bond market, and in fact, the equity market's not that different, is that we've had years where the bond market was down 9%, 7%. By the way, we can go back to the early 80s and see that it was not, it was never down as much as we were down last year. Right. So that measles chart shows you we always have periods of down markets, right? Pretty much in every year. But what was unusual about last year was that we finished the market with the year with such a bad year. This year, you have a little bit of coupon, so you have a little bit of cushion. And the Fed is probably closer to the end than to the beginning. Right. They've been going more slowly. They've taken some pauses. There's a chart you have here that shows that, in fact, the rate hiking cycle, in other words, how quickly did the Fed raise rates and how high did they go, was the highest, fastest in the last 35 years. Right. And that, on top of the fact there was no cushion last year, caused the situation to be really, really dire. Now, this chart shows the last 5 hiking cycles. And it shows that last year was the steepest, so the quickest. Yes. I laugh because it says it's recent history. And so I guess it just underscores I've been in the market a long time because, in fact, I can remember the period from 1980 to 1981. and I'm talking July 1980 to January 1981, 6 months, Fed raised rates 10%.
10%.
10%. So this shows a 5% rate increase over 13 months. We had a 10% rate rise in 6 months. And yet, if we go back to that chart we just looked at, Julina,
Right.
ooh, look at that.
Back here in the 80s, right?
Yeah. What was our max drawdown in that
9.
period? 2%. Yeah, 9's even before that. We had a
I
little
was
bit of
before it, yeah.
That was before that.
Right.
We had coupon cover. We had cushion.
That was
We
your
don't
buffer.
have cushion, that buffer. And that buffer makes all the difference. So we've had a period of much steeper, much faster rising rates in the early 80s. I'm sure there are people that can remember it. My late husband, you mentioned I'm a widow. He was a bond salesman at the time. He said you could not give away a 19% treasury.
Amazing.
You couldn't give it away. And by the way, boy, what we all shouldn't have done was to buy as many of those as we possibly could.
Right.
Because short-term rates went pretty high, but within 5 years you were getting 5% and you could have locked in at, 15, 16. And we didn't.
Yeah.
Which leads us to a conversation we should have about today, which is people ask the same question, I bet, today. In any case, the question we would all have is the Fed raising rates really impacted the markets. We can see how steep it is on a different chart here, which you show it going back.
Why would I want to get back in?
Why would you get back in now? And I would say a couple of things. First, the Fed has told us they are closer to the end of the beginning. They publish their projections. Now they're projecting a couple more rate rises. I personally don't think that that's going to happen. We just discussed my view on core inflation, sticky core, less shelter. We know that shelter lags. We know that Fed actions take somewhere between 12 and 18 months to be successful. And that's been in the press, that number's out there, 12 to 18 months. They talk about it. Banks talk about it, I'm sure. Your investment committee talks about it, Julina. So with core sticky inflation being where it is, if I was on the Fed, I would be voting not to go. But if the market expects they're going to go, the Fed often leans into the market expectations to not create more volatility. Regardless, they are very close to the end. There are some people on Wall Street that think the September move will be a cut in rates.
Yes. And my firm has talked about that because we agree with everything that you have said. If anyone has listened to my interview with our founder and CEO, Bob Paolucci, he has spent a lot of time talking about why inflation has come down and how it has. And I think it's right to your point. So I love that you're saying this.
Yeah, I really do think. And if you look at the Fed's forecasts versus the market expectations, by the way, the market expectations aren't as high as the Fed's estimates in the short run.
Right.
They end up a little higher in the long run. But either way, what happens when the Fed starts cutting rates? Rates go down, prices go up.
And prices go up. Yeah.
So a couple of things. You might ask me, well, but rates are so attractive. This is Fed funds rate. Maybe I should just own short duration, right? My short duration portfolio has been doing great. I've been yielding a lot. It yields more than my longer duration bonds. Why shouldn't I just stay in short? And this shows you one of the reasons you shouldn't stay in short. If you stay in short, that yield on your short duration portfolio is just going to fall down this cliff, just like the Fed funds rate. So you'll be yielding less and less every year.
And Priscilla, if I can really quickly, I think the reason we're addressing why would you stay short is because last year was such a difficult year and they kept raising interest rates. A lot of us that own bonds and wanted to continue to own bonds, we moved to the short end of the bond market so that we would have less interest rate sensitivity. So there's a lot of money sitting there.
A lot, right? And not the least of which is that the yields in short-term, 1-year funds are really attractive.
They're just as attractive. Yeah.
Even if not more attractive, right? So it seems like a real sweet spot.
Yeah.
Not a lot of volatility, not a lot of risk, pretty good yields. Why shouldn't I just hang out there?
Yeah.
Right?
Exactly.
And the reason you don't want to just hang out there is because what does a short duration fund mean? It means that the manager of that fund is constantly having to reinvest because those investments mature.
Right.
And if the Fed is lowering rates, what's that investor continuing to do? Reinvest at lower rates and lower rates
and lower
rates and lower rates and lower rates, and you're going to end up with a lower yield. In a fixed in a longer duration, and I'm not talking about 30 years. I never I really mean that never for individual investors would recommend a 30-year investment. When I say long duration for an individual investor, I mean like 10 years.
Okay.
A 5 to 10, I think, is a sweet spot today in the marketplace, because what happens when the Fed starts lowering rates? Prices go up, and you get that price benefit only in a bond that has duration. And I've used that term, and maybe we should define it.
Yeah, please.
Duration basically is the amount of time it takes for you to get your money back. So if you think about, if you buy a bond with a 0 coupon and it's a 5-year bond, when are you going to get your money back? In 5 years.
5 years.
That's 5 years. If you have a bond that has a 10% coupon, like we could buy one today, wouldn't that be great? Then you're getting some amount of coupon, so your duration's shorter than that 5 years. But the duration of your bond, if you think about, if I could use my elbow as a fulcrum, and you think about a fulcrum, or when you used to play crack the whip ice skating, maybe when you were a kid, the tail is a lot more volatile.
Yeah.
Well, that means when rates go up and prices go down, you get more benefit at the longer end than you get at the short end, right? And so there is a lot of benefit to owning duration here as we think about an environment where the Fed may be lowering rates. I'm going to tell you an interesting anecdote. Several years ago, many years ago, a bank, which shall remain nameless, offered their investors 2 CDs. You could buy a 1-year CD yielding 5%, or you could buy a 5-year CD yielding 5. Well, 1 year yielding 5 or a 5-year yielding 5.
5-year, yep.
Right. So what did pretty much everybody take? Like 90% of the people. They took the 1 year.
Yeah.
Why invest my money for 5 years when I could only invest it for 1 and get the same return?
Right.
Okay, 1 year passes. You go back to the bank, your CD has matured, it's time to reinvest it. Oh, I want my 5% again. Yeah, no. It's 1% today.
Exactly. And I think that's a great point that is so pertinent to today.
Yes, exactly. And I think that easy money seems really attractive today, but you're going to be chasing falling interest rates in a short duration portfolio where you could be locking in higher rates today, where you not only get a higher yield, but you get the benefit of price appreciation as yields come down. So you get 2 benefits from locking in. And I'm not saying 30 years, as I said, a 5 to 10 year duration portfolio. I really like an intermediate duration fund. I think that's very attractive. By the way, I get asked this question all the time. Well, that's great if I own a ladder of bonds, it works like that, and I own my own bonds. But what if I own a mutual fund? Nothing really ever matures. Do I really get those benefits? And the bottom line is it works exactly the same as a big pool of individual bonds, because that's all it is. So a mutual fund and an actual individual portfolio, the math is exactly the same.
Yes. And the manager that you're hiring in that mutual fund is doing that math.
Knows the math.
Exactly. No, that's a great point. So you talked a lot about, you're starting to segue a little bit into the opportunity today.
Yes.
So if we can talk about some other opportunities that we see to own bonds today.
So I talked about the fact that bonds as a portfolio diversifier are fantastic. And we talked about treasuries being the classic. Municipal bonds, I think, are very attractive if you have a high tax rate. If you live in New York and you're paying a marginal tax rate of 50%, an intermediate duration, let's say 6-year duration, high quality muni bond portfolio, you can probably get a yield somewhere around 2.5, if not slightly higher. On an after-tax basis, that's like getting 5%. Right. So I think that's very attractive. Now, I will talk about the fact that if you don't live in New York or California, your fund opportunities may not be as attractive just because there's not as much of a huge pool of funds.
It's not the same pool.
It's not the same pool. However, and there are national funds, and people often tell me, well, I can buy a national fund. Here's one of the challenges of a national fund. They are invested with a benchmark that is an index. The index represents the entire national muni bond market, of which about 40% are New York and California.
Correct.
The people that live in New York and California who have high tax rates have a higher level of demand for those bonds. And as a result, the prices are higher and the yields are lower because on an after-tax basis, they do fine. Why do you want to own those bonds that have higher prices and lower yields? You don't. In fact, it's a negative for you. I think if you live in a smaller state or a state that doesn't have an attractive in-state municipal fund, that a laddered muni bond portfolio, which your advisor, Julina, I know you can do that for your clients, builds for you, is a really attractive option in today's market.
Okay. Yeah.
Look at one that has a duration of 5 years,
Right.
maybe do something that has a 3 to 7 year maturity or something, I think. And then every year as those bonds mature, you roll them into the higher yields. And I think that's an attractive option.
Yeah. And I also think, oh, sorry, I was just gonna say,
no, please.
To your point, having an understanding and doing the due diligence of these different opportunities. Like, for example, a lot of our clients are in Connecticut where, we're based. And, Connecticut has some options, and this is where we go in and do the due diligence and understand what exactly are they buying if it's going to benefit our clients that reside in Connecticut. That's
right. And I think there's great examples. I mean, Connecticut has had a lingering unfunded pension problem. And so at the state level, some of the state level bonds may not have the same credit profile as the town of Westport, which is a nice AAA, right? So there's a huge variety of credit options in the state of Connecticut, both good and riskier. And if you're getting paid enough for the risk, you might want to do something. But Connecticut does have both good and bad options, and some states don't have that. So it's very attractive. So
thanks for sharing that.
Yeah, no, that's a great point. I want to go back to that slide one more time.
Oh, I'm sorry. Yeah.
No, because a couple other.
Oh, we missed. I'm sorry.
No. Core bonds. We'll come back to core bonds, and really, that's just we talked about the Barclays Aggregate Index and what was in it. But high yield bonds in emerging market debt, people say to me all the time, "Oh, well, I really want more yield from my fixed income. I have no income in fixed income." I think years ago, I did a little cartoon for some speech I was giving somewhere, and it was a takeoff on that old, I guess, Burger King ad or whoever it was, where those two older ladies lifting the bun and go, "Where's the beef?" And I turned it into, where's the income? Because there was no income in fixed income anymore.
Of course you did.
Yeah. But high yield looks like an area you go, wow, but it's fixed income, all those great benefits, and it yields more.
Yeah.
And it's true that high yield does yield. And it yields more for a couple of reasons. Typically, high yield yields more because there is more credit risk. You get paid your coupon, your interest payment on a bond is a function of several things. Duration, how long it's going to take for you to get your money back.
Right.
Credit risk. So U.S. government, AAA,
right.
High yield bonds below BBB. Right.
Yeah.
And then you also get paid for sort of volatility and some other things. And I'm not going to go into all of those today. But high yield bonds incorporate some amount of credit risk. That's not my issue with high yield bonds today. Stock market's doing great. High yield companies, they took advantage of that candy jar. They borrowed money really at low rates. They locked in that money. So high yield companies typically have to roll their debt. When they have to roll it, if they all roll it at the same time, that's called a wall of maturities. All the bonds mature at the same time. That's been pushed out. That is not the risk.
Yeah.
The risk is, are you getting paid enough? So if we are going into a recession, high yield bond spreads typically in a recession are double what they are today. What is the spread? The spread is the amount of extra interest rate you get versus the comparable maturity treasury. So
that extra income for the risk.
Extra income for the risk. Treasury safe.
Yep.
High yield risk, pile it on top. Yep. In a recession, that spread is usually twice what it is today.
Right.
So even though companies aren't at greater risk credit-wise, the price is at risk. By high yield bond today, you're at risk that the price falls dramatically if we go into a recession.
Yeah.
So not my favorite part of the market. And I should mention that even less favorite of mine are floating rate bonds, which is another area of high yield that people say, yeah, but it floats. It's got very short duration. How much risk can there be?
Yeah.
And historically, that was a higher quality part of the market than high yield bonds. And it had some attractive characteristics. Well, what happened in the last 5 years? Candy jar. If you could take advantage of that low rate candy jar and lock in financing, you did it.
Yes.
So what about those companies that couldn't do it, and why couldn't they do it? They couldn't do it because their profile's too risky. Nobody would lend them money for 5 years. That's what's left in the floating rate market.
Yeah.
Would not go there today either. So there are a couple other options. Emerging markets debt is a category that I would say, first of all, to be able to take advantage of, definitely a mutual fund. Definitely. There are two ways you make money. One way is if you buy local currency bonds and if currency fluctuates. And I will say the banks of the world are lowering their yields a little bit faster than we are. They're ahead of us. So there's some price appreciation there, but picking and choosing is not our job. And diversification is not possible if you buy one or two emerging market debt bonds. That's an opportunity, very selective. You want a manager that really knows what they're doing, but there could be some opportunities in the emerging markets, I think, today.
Yeah.
But what this shows you is the big risk of doing that. And that is that both high yield and emerging market bonds are highly correlated to equities.
Yes.
So all that benefit we want from fixed income, where when our equities go down, our fixed income goes up. Yeah, no. Equities go down, high yield bonds go down, emerging market bonds don't go down, right? Equities go up, they go up together. So it's not a substitute for your core.
Yeah.
It is an option for you to pick up additional yield, but not as a substitute for your core. And the best thing I can say in fixed income is the same thing I said in fixed income versus equity.
Right.
Diversify.
And I think it's such an interesting point because really when you look at high yield and floating rate, as you described, they are more in equity in disguise.
That's
Even
right.
though they're bonds, they react very different in economic conditions than treasury or bonds. So if you are going to own them, which our clients do, they're not the foundation of our bond piece.
Absolutely not. Absolutely not.
And they're a diversifier for us.
They are an extension of your core. They are not a substitute for your core.
Yes.
Absolutely.
And that was what you became so known for with your fixed income triangle was start with the foundation, start with the basics, and then build out the extension. So
and layer on, right? And if you're going to add high yield, one of the things you're adding, and I think your next chart shows us this, is that you're adding not only correlation to equities, but volatility. Exactly. So high yield bonds and leverage loans and EMD not only come with higher yield, they come with higher volatility. We talked about the value of low volatility, right? So if you're going to add those bonds, you need to add something that offsets that volatility. And we can see that might be ultra short. It might be some of these funds that the manager is looking for absolute return. And for those of us that remember ninth grade math, what did absolute numbers be? They were always positive.
Yeah.
And there are managers who seek to not have rules. Their rules are, we're just trying to give you a positive return.
Yeah.
And that might be a way to offset it, although you are substituting one risk for another, and the risk you're taking on is manager risk. So lots of due diligence. That's why people use you, Julina. They use you to help, identify that risk, vet the managers, really have confidence in who's managing that money.
Yeah.
But leverage loans, US high yield, EMD, yes, higher yields, higher volatility. We can see, go ahead.
No, I was just going to say, for the listeners that have are looking at this or listening and starting to realize that there are so many different types of bonds that are out there that react differently. I should have asked this in the beginning, but can you talk about the difference between the size of the bond market relative to the stock market? Because I always think that surprises people.
Yeah, I think it's true. Of course, we know the bond market is larger than the stock market, and it's significantly larger. But what makes it more complicated is that it is not a thing. It's not a homogeneous thing, right? The stock market, reflects one thing: equity in companies, right? The bond market, there are different positions in the debt structure. There are different types of bonds. There are bonds which are just passing through some debt. There are bonds that are backed by corporations, U.S. governments. There are high yield, right? There are foreign governments. There are state and local governments. If you think about the municipal market, which I said earlier, it's like a microcosm of all of it, but is an incredibly diverse market. And what makes it diverse and makes it challenging but fun to invest in is not only do each of these sectors have different volatility and yield profiles, but they have different behaviors in the market. So we could spend hours on the mortgage-backed market alone, which is a really interesting market. It's about 30% of the U.S. aggregate index are mortgages. And what are they mortgages? They're your home mortgage and everybody's home mortgages bundled up together, wrapped by a guarantee by the U.S. government and sold as a security.
Yes.
Okay. Yeah. So where were mortgage rates over the last 5 years? They were low. right? If you got a 3% mortgage, 275, whatever you got, you locked it in, man, you were happy, right?
Oh,
Because
of
it's
course.
got up to 7%, right?
Yeah.
Well, all of those 3% mortgages are piled into securities, which when yields are 3% or 2.5% look pretty attractive. But when yields are 5%, how attractive are they going to look?
Right.
Furthermore, you are not paying that thing off anytime soon. You have a 3% mortgage you're holding on as long as humanly possible.
Yeah.
Right.
Yeah.
And so that profile of that market makes that market really, really different than some of the other fixed income markets. We could spend hours on
That's
that.
a great point. Yes.
But the markets themselves don't all behave the same way.
Yeah.
And so it's a very, very, very large market with lots of individual sectors that have all their own different performance characteristics, which is challenging but fun.
It's fascinating.
It is.
Yeah.
It is. So I want to spend a second taking that chart. Oh, if we went back to that last chart.
I'm sorry. Yeah.
No. We just have a little diamond there in the middle of this chart, which says, hey, what about a diversified fixed income portfolio?
Yes.
We talked about a 60-40 equity fixed income. What about a fixed income portfolio that's diversified?
Yeah.
Can I get a little bit more yield? Can I have a little bit less volatility?
Right.
And this chart shows you that your volatility is a little bit higher, but your yield is higher with a diversified portfolio. Yeah. So higher yield without giving up much in the way of volatility, very attractive. And the next chart I think you have is your jelly bean chart again, but it's a different jelly bean chart.
Just bonds.
Just bonds. And this is actually a graphic representation of the model that I built at JP Morgan called the fixed income triangle, which I should say should not be a triangle, but I inherited an old triangle and used that to build on for the model that I built. But basically this chart shows you that just like an equity fixed income portfolio, a fixed income portfolio that diversifies all those different sectors,
right,
will give you a smoother ride and more consistent returns, right? So the yellow box on this chart, which is the diversified portfolio going back to 2011, hangs out in the middle of the chart. Yeah. And yes, last year, even your diversified portfolio lost 11%. Yeah. But an annualized return for the last 15 years was 3.5%, and it did it with fairly low volatility. And it's those two things you want from your fixed income, decent returns, decent income, low volatility.
Yes.
Right. So if I look at my diversified portfolio over those 15 years, it yielded average annual return was 3.5%. Right. My core bonds was 2.7. So by diversifying, and by the way, my ultra short was less than 1%. Less than 1%. So while last year ultra short yielded you 1.4%, that's the only time in the last 15 years it was your best performer. Yes. Right? So let's just remind ourselves of that and remind ourselves that you can get a little bit more yield and still have low volatility by further diversifying within your fixed income portfolio. Yeah.
Diversification is such a simple term, but yet I think it's hard for people to follow through in the long term, which I think is why roles like myself are important. But I believe when you think of the rule of diversification is that it never works at a point in time. It is never the winner.
Correct.
We know it works over time.
Exactly right. I think that's such a great point, Julian, because it's so easy for us to say, yeah, but the stock market's really hot right now, or this is really great right now, and I don't need to do that. But we know the data shows us that people that try and be stock market pickers get out at the wrong time and get in at the wrong time. And it's exactly the same thing with a diversified portfolio. Yeah. You leave so much money on the table if you try and time it. That having a diversified portfolio doesn't mean you don't rely on people like you, Jelena, to make moves, change managers, rebalance, change different mixes. But committing to that diversification and staying committed to it is going to give you a better return over time. We know it, the data shows it.
Yes. I think that's a great way to end the conversation. And I know it was a lot that we went through, but I'm hoping that the listeners that really went through it, I know that they're going to learn a lot about the bond market because it is so intricate.
It is so intricate. And we didn't even talk about active management, which I will give you a plug, Julina, on the end here and say,
Oh,
I
yes.
firmly believe active management is a really critical element of your fixed income portfolio. I actually don't feel that strongly about that for the equity market. I think you can own some indices in the equity market and have them work for you.
Yeah.
But the composition of the indices in fixed income means that they often incorporate a lot of those riskier securities or securities that have different performance characteristics,
Yeah.
or they exclude some securities you want to own. All of that tells me that fixed income, and I am a firm believer of this, should be actively managed. And that's the same whether or not you have an individual bond ladder, you have a mutual fund, or you have an ETF. And there are plenty of actively managed ETFs, but I believe in any vehicle you're in, active management and fixed income is critical.
Yeah. And I think you bring up such an interesting point in how quickly this environment is changing, because you couldn't use the words active ETF a decade ago,
You
right?
could not.
I think that's really, and so
in
it's
fact,
changed.
people thought it was impossible. How could you
Exactly.
possibly do it? And
Exactly.
I think it's the future, actually. I wouldn't be surprised to see the majority of mutual funds out there eventually morph into ETFs.
Yeah.
Wouldn't
But
be
I think,
surprised to see
a
that.
lot of advisors that choose active managers, whether it's the stocks or the bonds,
Yes.
we do get the question a lot, why are we choosing to pay more to use an active manager? And hopefully your explanation of the bond market today helps individuals understand that. So
I hope so.
yeah.
And you can call me anytime. I'm happy to chat.
Priscilla, I miss our drives together, and
I do
our
too.
chats. I knew you were going to come with some great insight. I'm thrilled that you were able to do that for the listeners. For the listeners that did not see the presentation, if you were listening to it, I would highly encourage that you go either to my website or to my YouTube. Selfishly, that is new, so I would love to have some followers, and please look at the slides. They're so powerful. And I will also thank JP Morgan for allowing us to use the slides that they have for such a long time put together for us to be able to share with clients and to the audience. So I think the visuals are very powerful.
I agree with that. And thank you.
Priscilla, thank you again. I would love, you can come on anytime you want.
I enjoyed it. It was so much fun. I probably talked way too much because you can tell how enthusiastic I am about the bond market. And as you and I know, some days we just chat for 45 minutes just about the market, just off the cuff. So it was fun. And thank you for having me.
No, anytime. Thank you, Priscilla.
My pleasure.